A very good afternoon to you all, friends. I'm Sanjeev Singhal, Central Council Member and Chairman, Auditing and Assurance Standard Board. On my behalf and on behalf of my Vice Chairman, CA Vishal Bhai Doshi, I welcome you all to the first webinar of this council year of AASB. Overall, it is the second program by AASB in this council year. There was one seminar on bank audit at Karnal on 27th of February, and now this is the first webinar. Like last year, friends, it will be our endeavor to keep updating our members. In the last council year, which ended on 11th of February, Auditing and Assurance Standard Board has done 131 programs in which more than 194,000 members attended those programs, and more than 5 lakh structured and unstructured CP hours were generated. We covered every topic, but we believe that knowledge requires constant upgradation. Hence, we'll be presenting the entire series again. And let me, at the outset, tell you that while this will be my second year as a chairman in the Auditing and Assurance Standard Board, this year the President, C. Aniket Talati, has also given me the responsibility of chairing the Public Relation Committee of ICAI. So together, of course, audit quality impacts the image of the profession, and it impacts the public relations. So it will be our endeavor that both the board go hand in hand together, and the image of our profession is enhanced through good quality audits. Friends, this year, while we'll be continuing the initiatives of last year, for example, we'll be forming an expert panel to answer the queries relating to bank audits, an expert panel to answer the queries relating to the statutory audits. We will be taking few more initiatives apart from the technical guides that we present. We will be taking another initiative of an online quiz, whereby once in a week we will fix the day, which could be a Monday or it could be a Friday. An online quiz will be hosted, and the top 10 winners of that quiz will be given mementos. And these quiz will be on audit-related standards and audit-related questions. The idea is to promote awareness about audit, and we wish to hold it for about 45 weeks in this year. So please stay tuned for that announcement. Friend, coming to today's topic, materiality in planning and performing an audit, and evaluation of misstatements identified during audit. Materiality is so very important because by nature, we can do only test check. We can't do 100% check. So what is that we are supposed to do? What should be our materiality level? What are the errors, which are required to be reported? What are the errors which are required to be corrected by the management? What are the errors which, even if they are not corrected, an auditor can do with them? What's the concept of planning materiality or performance materiality, tolerable error or summary of audit differences, SAD, etc. And then what is the impact of these errors during the audit? That is what we are going to discuss in today's topic. The topic will be taken by C.A. Sandeep Dinodia ji, who is the managing partner of S.R. Dinodia and Company LLP, a well-known chartered accountant firm. Sandeep ji has completed his BCom from the prestigious Shriram College of Commerce in 1983, and is also a law graduate from Delhi University in 1986. He's in FCA since 1984, and Mr. Dinodia is the board of directors of many large public listed companies as an independent director, offering invaluable guidance on the company's policies of good corporate governance and helping solve their compliance issues with the myriad of laws under SEBI, Companies Act, and FEMA, etc. In his capacity as an assurance head of SRD, he has been involved in supervising statutory audits, internal audit, tax audits, due diligence audit, management audit, banking institution, a large public and private sector company for more than 35 years. Great human by nature. I know Sandeep ji from last many years, and I know he and his firm stands for values and ethics. It's great to have you here, Sandeep ji. I appreciate the time taken by you and being the opening batsman in the first webinar for this council year. Really remarkable. I know that this is a busy season. The preparations of the listed company audits have started. So we really appreciate and thank you for taking out time. and we would request you to kindly start your deliberation. Thank you.
Thank you. Thank you, Sanjeev ji. Thank you for those lovely words. And I'm not sure whether I deserve all of them, but yes, as a humble chartered accountant who's been trying to keep myself updated with the various pronouncement changes that have happened in the profession since I qualified 37 years ago. And our profession has gone through a complete sea change. All the things that we had learned when we gave our exams are now probably mostly outdated. But what is now outdated is the ability to learn, ability to read, and ability to adapt. And that is what we have to continuously keep on doing. And the new students who are coming into this profession and the others of my colleagues who are working in this profession, we are, I think, all working towards taking this profession to greater heights to make the Institute of Chartered Accountants of India the leading institution in the world on accounting and assurance, so that the whole world looks to India as a place where our financial statements are audited at the highest standards, better than anybody else in the world. So that's what we are all trying to do. And you have given a lot of guidance to all of us, and we look forward to your guidance always when we get stuck. And you have always helped us. You've always taken out the time to answer queries and guide us wherever we need it, and our teams have needed. So thank you. And thank you for giving me this opportunity. It helps me interact with my colleagues, but also for me to learn myself. So when you give a presentation, you first read yourself. So it gives me a chance to learn. So it's my learning, and I'm grateful for that. So with your permission, should I start?
Please go ahead, Sandeep ji.
So I'm starting my PPT.
Anil ji, had to make him co-host. Okay, fine.
Is it visible, the PPT?
Yes.
So the topic of today's discussion is SA 320, Materiality in Planning and Performing an Audit, and linked to that is SA 450, which is evaluation of misstatements identified during the audit. And I think both these topics are actually completely interlinked and extremely important while we plan and execute our audit and attestation function. My presentation today will have these, we will go into the scope of these essays. Then materiality, we'll talk about in context of an audit. We'll talk about types of materiality, the determination of overall materiality, then coming down to what is performance materiality. We'll give some illustrations and try to make it more interactive in that manner for understanding. Then we will talk about materiality level or levels for particular classes of transaction, account balances and disclosures. We'll talk about revision of materiality. And then finally, we'll talk about documentation that is required, which is a very essential part of any audit exercise. So to start, the scope of this, since SA 320 and SA 450 are linked, the scope of SA 320 deals with the auditor's responsibility to apply the concept of materiality in planning and performing the audit of financial statements. So materiality has to go all throughout the stage of planning, and again through performing the audit of financial statements. Once we have done that, then SA 450 kicks in, where the application of materiality is required in evaluating the effect of any identified misstatements during the course of the audit. The first step, obviously, in any audit is once you find a misstatement, you present it before the persons charged with governance and ask them to correct those misstatements. If they're corrected, that's the end of the matter. If they're not corrected, Then the question comes how they will impact the financial statement while we are forming an audit opinion. And then the related question comes that are these misstatement material or not material? So if they are not material, then there are steps that we can take. We can take a representation from the management, and we can then bring it below materiality threshold levels. Or if they are material, then we have to see whether it requires qualification or some other disclosures in the audit forming of audit opinion. Going a little bit now in depth into the materiality in context of an audit. So we have as everybody knows, there's a financial reporting framework in which we all operate while we conduct our audits. This financial reporting framework is actually a set of criteria used to determine measurement, recognition, presentation, and disclosure of all material items appearing in the financial statement. So the financial reporting framework is nothing, but it actually, whether we go to Schedule 13 or we go to other disclosure norms of information that is accompanying a financial statement, these are all under the financial reporting frameworks where we as auditors are given the responsibility to ensure that they are true and fair, and they are correctly presented, not only financially, but also in terms of disclosures. So when we go to these to audit these financial under the financial reporting framework, what is important is the misstatements that we find. They have to be material in nature, if in aggregate or individual, may influence the economic decision of users of the financial statements. This basically means that we not only have to look at each and every misstatement in isolation, but also in aggregate. If they are aggregated and together, they will influence the decision of the users of the financial statement, then they become material. Judgments on materiality can be made. Now, what is material? This judgment can be made in the light of surrounding circumstances that are affected by the size or nature of the misstatement, or a combination of both. So here we have to, as an auditor, apply our judgment on how we determine the materiality in the light of each and every circumstance and each and every company, which will differ from company to company, size of the company, nature of the activities, and nature of the misstatement that we have found. Judgments about the matters that are material to users of the financial statement are based on consideration of the common financial information needs of users as a group. So we have to determine that this financial statement that we are auditing and we are presenting a true and fair view, who is the user, whether there is a public company, the public shareholders, if it is a lending company, then it's lenders or investors. If it is a startup, who are the people who are going to use this financial statement, and that will also be a major factor in determining the materiality for us to determine whether this information that or misstatement that we found are important enough or not. Now, what is a misstatement? We have SA 450 defines this misstatement as the difference between the amounts. So it's not just the difference in amount, it's also classification, it's also presentation or disclosure of a reported financial statement item, and the amount, classification, presentation, or disclosure that is required for the item to be in accordance with the applicable financial reporting framework. Misstatement can also arise from an error or fraud. So not only, to summarize this misstatement, because we will be talking about misstatement again and again and again. So we must understand that misstatements can arise from an error and fraud also, but they also could arise when we do not present the information correctly as per the financial reporting framework, and we misclassify it. For example, now the new Schedule 3 asks you to classify sundry debtors under various categories of more than 1 year, 2 years, 3 years. So if we do a wrong classification, that also is a misstatement. But there we have to see whether the wrong classification, the amount is material or not, depending on the size and nature of the organization. So this is where the materiality concept comes with the misstatement concept. You have to marry the two together. Yeah. Now we come to the basic concept of materiality. The concept of materiality is applied by the auditor both in planning and performing the audit. So the first step of any audit is obviously planning. And in evaluating the effect of identified misstatements on the audit and of uncorrected misstatements, if any, on the financial statements, and informing the opinion in the auditor's report. So the concept of materiality has to is evaluating the effect of the identified misstatements. So once we have planned and executed the audit, we will come to misstatements, and then we have identified misstatements which are uncorrected. So like I said before, then we have to say whether this unidentified, uncorrected misstatements are important enough to satisfy us to go to the next step, or because of the concept of materiality, we can ignore them and do other processes. The concept of, as you know, that the assurance function, our audit reports that normally are issued have the concept of true and fair view, which also recognizes that when we give a true and fair view, it is we have to apply the concept of materiality, since we cannot check 100%. We are not supposed to check 100% of the transactions, and hence materiality gives us a tool where we can plan our audit, do our sampling checks in a manner that we are able to form an opinion whether the financial statements are true and fair or not. And this materiality must be given due importance in preparation and presentation of the financial statements. Materiality thus is a crucial factor for the statutory auditor in forming or expressing an opinion, mainly based on judgment in respect of certifying financial statement as to their true and fair presentation, or whether the financial statements are presented fairly. Now, we use the word uncorrected misstatements. This is again being defined under SA 450. Misstatement that the auditor has accumulated during the audit. Again, the word accumulated means not just a single one, but there could be a accumulation of similar entries under various heads or various items of assets, liability, expenditure, or income, and they have not been corrected. They become uncorrected misstatements, accumulated amount. We continue with the concept of materiality. The materiality term has been referred not only in SA 320 and SA 450, but also has been referred under various other pronouncements, and some of them which are also been given in the implementation guide of the ICAI. I picked up some of them from there. So it gives us a broader idea of the term materiality and how to apply it. Because it is really a question of judgment. There's no hard and fast rule on materiality calculation. It is, you'll keep reading everywhere that it is a judgment-based item. So when we get into judgment of materiality, we have to think about a plethora of items and things and circumstances when we apply materiality, and there's nothing straight and right and wrong in materiality. Going first to Ind AS 1. Presentation of financial statements. An entity shall separately present separately each class of similar items. An entity shall present separately items of dissimilar nature or function unless they are immaterial except when required by law. So here the concept of immaterial has come in. They have not said material, but just use the word immaterial. So if they are basically what they're saying is that you will present each item separately unless the amount is not material. Then you need not present it separately. You can club it under an expenditure, could be clubbed under miscellaneous expenses if it is not material, other than showing it separately as a line item in your P&L accounts. A simple example could be that. Then Ind AS 34, interim financial reporting, says in deciding how to recognize, measure, classify, or disclose an item for financial reporting purposes, materiality shall be assessed in relation to interim period financial data. So then materiality for interim financial reporting has to be based on the interim data, not the annual data. So you, because you're presenting an interim financial statement, which will be probably for a period less than 12 months, then you have to take materiality based on figures of less than 12 months also. In making assessments of materiality, it shall be recognized that interim measurements may rely on estimates to a greater extent than measurements of annual financial data. This is because annual financial data is always available for 2 or 3 years, but a special purpose and interim financial reporting, you may not have data for that period that we are doing an assessment or doing an assurance function. So here you have to rely a great deal on your judgments and also on making interim measurements for estimates. So we will rely on estimates while making this calculation of materiality. In the guidance note on accrual basis of accounting, in the context of an audit, states as follows: the aspect of materiality is a vital factor as to the nature and extent of audit coverage required in conduct of an audit. The question of materiality has a direct bearing in shaping an audit programmer aiming to conduct an audit effectively. I think this is one of the most important paragraphs of the whole essay and of the implementation guide, where we are given a very clear guidance that materiality is an important factor for determining the extent of coverage. How much should I cover when I check assets? How much should I cover when I check liabilities? How much should I cover when I check expenditures or income? And what is the acceptable level of materiality up to which, if I conduct an audit and tomorrow there's a mistake found which is smaller than my materiality level, I will not be held liable for not properly performing my attestation function. Para 30 of the Preface to Accounting Standards issued by ICAI with qualitative characteristics of financial statements states as under: the relevance of information is affected by its materiality. Information is material if its misstatement, that's omission or erroneous statement, could influence the economic decisions of users taken on the basis of that financial information. Materiality depends on now this is extremely important. Materiality depends on the size and nature of the item or error judged in the particular circumstances of the misstatement. So the materiality has to be applied to the circumstances of the misstatement and can vary from circumstances to circumstances. Same thing can be very material when we look at a misstatement of 10,000 rupees in a company that has a turnover of 1 crore. But if a company has got a turnover of 100 crores, the same misstatement may not be material at all. So materiality provides a threshold or cutoff point rather than a primary qualitative characteristic which the information must have if it is to be useful. So this cutoff point of materiality helps us plan our audit better, helps us execute the audit better. And if we find that there are if there are any errors that are much smaller than our materiality level, we can then take a call whether they don't fall under various other categories that we will discuss further of misstatement, and we can overlook them in terms of giving a true and fair view of the financial statements. Disclosures in addition to consideration of materiality, as per guidance note division 3 and division 2 of the Companies Act, any item of income and expenditure which exceeds 1% of the revenue from operations or 10 lakhs, whichever is higher, in addition to consideration of materiality as specified in general instructions for preparation of financial statements of a company. So, friends, this is the guidance note on Schedule 3, Division 2, which means for Ind AS balance sheets. It is basically saying that any expenditure or income which exceeds 1% of the revenue from operations or 10 lakhs, whichever is higher, must be disclosed separately. But this also has a qualifying factor in addition to consideration of materiality as in general instructions. So we have to also see materiality. In some cases, the materiality could be higher or could be lower. So based on that, the disclosure norms has to be judgmental, and it has to be judged based on items of each case. But this is the guidance given by the Companies Act, Schedule 3, Division 2, after the amendment. So this is a very major factor we must keep in mind while determining the materiality for disclosure in the financial statements. Now we come to the real nuts and bolts of what is materiality and how do we calculate materiality. So there are two parts of this. One is the overall materiality for the financial statements as a whole, and a subset of that is the performance materiality, which is a percentage of the overall materiality, which we'll discuss further. Then there is a specific materiality for particular class of transactions, account balances, or disclosures, which again we will discuss further. Determination of overall materiality, the first step, is a matter of professional judgment and is affected by the auditor's perception of the financial information needs of the users of the financial statement. This, my friends, is the most important statement of this whole essay, that this materiality must be gauged in line with the needs of the users of the financial statements. We must always keep in mind that the statement that we are auditing must be used by the users, and whether we are giving them adequate comfort and disclosures so that they can arrive at informed decisions based on the financial statements. In this context, the auditor assumes that users have a reasonable knowledge of the business and economic activities and accounting, and willingness to study the information in the financial statements with reasonable diligence. So we are assuming that the users are knowledgeable, they know about the business, they also are willing to study it critically and carefully with all surrounding notes and disclosures holistically, and they then arrive at any decision that they want. So we are not looking at the users to be not diligent in their own reading also. We also recognize that uncertainties inherent in the measurement of the amounts are based on use of estimates. We all know that when we make financial statement, there are certain estimates that we use, which are used for making the financial statement. For example, likely outcome of pending litigations, useful life of tangible, intangible assets for the purpose of calculating depreciation, assumptions relating to employee benefits. This is the gratuity and leave encashment, actuarial valuations, and estimates for current and deferred income taxes, etc. So just few examples on what kind of estimates are used for preparation of any financial statements. We should also understand that financial statements are prepared, presented, and audited to levels of materiality. So this is what we are all talking about today, that the financial statements are not only presented and prepared, but also audited to the levels of materiality. And sometimes very small entries which are not material to the whole transaction or to the reader or do not affect his decision making could be left out erroneously or consciously, but those adjustments may not be termed as misstatements as per SA 450 and will not require us to go to the next step of either qualification or ensure or forcing the management or requesting them, sorry, not forcing, not the right word, requesting the management to make adequate adjustments in the accounts or corrections for those misstatements if they are not material amounts. A percentage is often applied to a chosen benchmark as a starting point in determining materiality for the financial statements as a whole. So this, friends, is the starting point of what we do to determine materiality, which is to apply a percentage. You will find that the percentages keep on varying. There's no fixed guidance for it. You will also find that there is on which benchmark we apply this also keeps on varying from issue to issue. And if you look at the implementation guide for to SA 320, you will find various examples that they have given in various situations on how to determine the benchmark and how to determine the percentage. And you will find all of them have different percentages and benchmarks. So it is really a question of judgment which the auditor has to make when he does the audit planning itself, and to determine what should be these two factors which will determine the overall materiality and then the performance materiality, and then we will go on to the trivial materiality. Now, what are these factors that may affect the identification of an appropriate benchmark? The guidance note of the institute has given certain benchmarks and factors which can be considered, and we will slowly go through some of them that they've given in the guidance. The factors could be elements of the financial statements, which is, of course, assets, liabilities, equity, revenue, and expenses. So these are the factors and attributes which are simple. And the first one that we should look at when we determine that we should apply the concept of materiality to one of these 5 items, or items on which attention of the users of a particular entity financial statement needs to be focused. For example, for the purpose of evaluating financial performance, users may tend to focus on profit, revenue, or net assets. So these are 3 items: profit, revenue, or net assets, which determine the catch the attention of the users for the financial statements, and we can use them as one of the benchmarks, or a combination of them for determining benchmarks for materiality. The nature of the entity, where the entity is in its life cycle, and the industry and economic environment in which the entity operates. So we have to see whether the entity has just started work, has it started commercial operations, is it an entity which is dependent, for example, a hydel power project which takes many, many years to start operations and then is dependent on nature and for its operations and income. A company which is starting manufacturing operations, or a company which is mainly dependent on research and development for developing of products. So it depends on where in the life cycle of the company we are doing the assurance function, and then we determine the benchmark on which we are going to apply the percentage for materiality. The entity's ownership structure and its funding pattern. So we have to see whether it is a debt structured, mainly equity heavy, is debt heavy, is it a huge amount of loans taken, or there are PE funds? Based on that, we can also be we have to determine on what benchmark we will use for materiality. Appropriateness of the example of benchmark, circumstances of the entity, which includes categories of reported income, profit before tax, total revenue, gross profit, total expenses, total equity, net asset value. All these are categories where we can be used as benchmarks for determining and applying the percentage for determining the materiality. For profit-oriented entities, profit before tax from continuing operation is the most widely used norm for determining materiality. In case of entities where PBT is very volatile, other benchmarks may be more important, such as gross profit or total revenue of the company, which are then a percentage is applied for materiality in case of volatility of the PBT. Coming back to the first step of materiality, which is the overall materiality, the determining a percentage to be applied to the chosen benchmark, which we have just discussed earlier, that the various kinds of benchmarks, involves an exercise of professional judgment. There is a relationship between the percentage and the chosen benchmark, such as percentage applied to profit before tax from continuing operations will normally be higher than the percentage applied to revenue. So, for example, if the revenue is 100 crores, you will obviously apply a very small percentage, maybe 0.5% or 1% for materiality. But if you come down to the profit before tax, then that figure on 100 crore may be 10 crores. And accordingly, the percentage that you apply to profit before tax will be higher, could be 5%, 10%, depending on the nature of the organization, on how much you want to bring the materiality level to, and below which you can ignore the transaction and you will still be comfortable giving a true and fair view of the financial statements. For example, the auditor may consider 5% of profit before tax from continuing operations to be appropriate for a profit-oriented entity in a manufacturing industry, while the auditor may consider 1% of the total revenue or total expenses to be the appropriate for a not-for-profit entity. Higher or lower percentages, however, may be deemed appropriate in different circumstances. So, as I've said earlier, and I'm repeating again, that these percentages are not fixed. We can only get guidance from the guidance note and the implementation guide, but really it's a professional judgment that we have to apply to each and every case when we determine the materiality at the time of planning the audit. The auditor takes into account materiality while determining the sample size for testing the account balances. Materiality forms the basis for determining audit scope. So we are doing this audit scoping and also for determining the sample size and levels of testing the transactions. In all three cases, this materiality is the first step that will then determine how I plan my audit, and I determine sample size, scoping, and levels of testing of the transactions. So really, this is the step for which we have been doing all this discussion. Sampling, audit scoping, and testing of transaction is based on this materiality that we've determined till now. The question of materiality arises at various stages during the course of audit. Thus, the auditor is concerned with materiality when determining the nature, timing, and extent of audit procedures, evaluating the effect of misstatements in the measurement and classification of accounts, and determining appropriateness of presentation of the financial statements. Now, coming to some illustrative examples for considering materiality. Factors for consideration, apart from size or magnitude of an item, its nature is also an important factor in determining whether or not it is material in the facts and circumstances of the case. Illustration: if the discovery of an illegal payment, even of a very small amount, could result in the closure of an enterprise, the item becomes material, even though it may be below our calculated materiality level. Similarly, inadequate or improper description of an accounting policy would be material if it is likely to mislead the users of the financial statements. So, not only figures could be wrong, but also disclosure of accounting policy could be wrong, which will lead the informed reader to reach a wrong conclusion. So both become material, irrespective of the amount. An item of information is material if its omission or misstatement can influence the economic decisions of the users of the information. That's what I just explained. For example, if fake sales of significant amounts are recorded in the books of the company, it would result in overstatement of sales. Now, this could be fake sales, or it could be a wrong application of cutoff on the reporting date of the sales. Uh, Wrong reporting could be that actually the sales have culminated as per the Sale of Goods Act in the first week of April. However, some companies try to inflate their sales in March and put them into sales invoices are raised in March, but actually the goods have moved to the buyer only in the next month. So this is an example of overstatement of sales, and that will also result in overstatement of profit. It will result in understatement of inventory, and this will give a potential investor may be influenced by this figure of profit and turnover and sales in the financial statements, and to invest in the shares of the company. So this will lead to a wrong conclusion by the user of the financial statements. And here, the materiality level again plays a very major role. But yes, the materiality has to be looked at in conjunction with the effect the error has on the financial statements. What is material also depends upon the particular facts and circumstances of each case. For example, an omission of sale invoice of 10,000 in an enterprise with a turnover of, say, 1,000 crores is not material. However, omission could be material if the turnover of enterprise was only 5 lakhs. So here the question of materiality comes in. So 10,000 rupee invoice is 1,000 crores. Even if it's missed out and put it into next month, or may not be material and need not amount to a misstatement. But if the turnover is much less, it would definitely amount to a misstatement, and materiality level would be hit. Materiality to users is based on common financial needs of users of group, and thus possible effect of misstatement on specified individual user whose need may vary widely need not be recognized. Paragraph 10 of the Framework for Preparation of and Presentation of Financial Statements issued by ICAI in July 2000 indicates for a profit-oriented entity that as providers of risk capital to an enterprise, investors need more comprehensive information than other users. The provision of financial statements that meet their needs will also meet most of the needs of other users that financial statements can satisfy. So if you are satisfying the needs of the most critical user, then mostly it will also satisfy the needs of other users who have a less critical stake in the company. Just one second. We come to the second leg of materiality. We were discussing the overall materiality earlier of the company as a whole. And the second leg is the performance materiality for which we perform the audit. This performance materiality is the amount set by the auditor, which is less than the overall materiality. You will see that in the guidance note and the essay, overall materiality word has been shown as materiality. So when we refer to the word materiality, it means overall materiality for the financial statement as a whole, to reduce to an appropriate low level the probability that aggregate of uncorrected or undetected misstatements exceeds materiality for the financial statements as a whole. This basically means that the performance materiality is less than the overall materiality for the financial statement as a whole, to reduce to the appropriate low level. So we are reducing the probability that the uncorrected misstatement will be above this level. Below this level, we will probably be very, very few, and which we can ignore at the time of forming an opinion. The auditor shall determine performance materiality for the purposes of assessing the risk of material misstatement and determining the nature, timing, and extent of audit procedures. So based on this performance materiality, we will plan our nature, timing, and extent of audit procedures. The determination of performance materiality is not a simple mechanical calculation and involves an exercise of professional judgment. It is affected by issues such as auditor's understanding of the entity. So the first step is to understand how the entity operates. The experience in the prior year's audit. Are we doing the audit for the first time, or have we done it for the past? And if we have done it for the past, we'll also know in the past what kind of errors, what level of errors have we found, and how have they been corrected. The nature and extent of misstatement identified in the prior year audits, auditors' expectations in the current year based on past experience. What are my expectations on the current year? How will it pan out? And the risk assessment of the business and the accounts and the internal financial controls will determine the risk assessment of the entity. We now come to some illustrations which are being taken from the implementation guide of the ICI, which will give us some idea on how to calculate this materiality, overall materiality, and also the performance materiality, and then we'll talk about a trivial materiality also. So an entity A is an entity for which the engagement partner has determined that the most appropriate benchmark to use in determining materiality is profit before tax from continuing operations, and applies 8% to this benchmark. The estimated profit before tax from continuing operations for this period is, say, 2 crores. This amount includes rupees 50 lakhs, which the entity A was awarded in damages in a court case. Since the current period estimated profit includes an amount that significantly increases it, and the amount is of extraordinary nature, the engagement partner decides to normalize the benchmark amount by excluding the damages from the current year profit. The normalized estimated profit before tax from continuing operations will therefore become 1.5 crores. Applying 8% to the normalized benchmark gives an amount of 12 lakhs. So this becomes my overall materiality for entity A. Then we come to performance materiality, which is a subset, and based on which I will structure my audit program and my scoping, my audit checks and sampling. This performance materiality is taken at 75% of the overall materiality, which becomes 9 lakhs. Now, why is this 75%? It could be 70%, it could be 80%. It really depends on the nature of operations and what level of based on my experience of the audit and the transactions and the company and what we discussed earlier, the needs of the reader of the statements and the stakeholders, what will be a good margin below which, even if there is an error, it will not affect the true and fair view of the financial statements. And that becomes a percentage to be applied, which is really a matter of judgment, which you will see further. Is also this 75% is not sacrosanct. It depends on item case to case and audit to audit. Then we come to a smaller amount, which is we call trivial materiality, which amount is considered we normally take at 5% of the overall materiality, not a performance materiality. Please note of the overall materiality, which comes to 60,000 rupees. So even if there is an error or suppose there's a short provision in this company of less than 60,000 rupees, I may not insist on the company to pass a correction entry or treat it as a misstatement, because this will not affect the overall true and fair view of the financial statements. Then we come to illustration number 2. In entity B, dealing in antiquities, goods are acquired through purchases of estates, attending auctions, and people bringing them to stores. The sales are made through entity stores, website, and at antiquity fairs. The business is privately owned and managed by the owner. The entity has considerable values tied in its inventory, which is partly slow moving. Revenue and profit has been relatively stable throughout the years. The entity has some external debt, but is primarily financed through retained earnings. So it's a strong company. It has retained earnings. It is not doing manufacturing activity. It has a small amount of slow moving inventory. The revenue and profits are stable. Engagement risk has been determined as normal, and there have been no significant changes in the entity's business, management, or internal control. It's a very stable company. Since the entity is profit oriented, the profit or revenue could be relevant benchmarks in determining materiality of the entity. Due to significance of the entity's inventory, net assets could also be a relevant benchmark. Using professional judgment based on these circumstances and knowledge of users' entities' financial statements, the engagement partner has decided to consider all these benchmarks together in determining the materiality. Let's see how. The engagement team estimated revenue, profit before tax from continuing operations, and net assets for the current period and made the following calculations. Profit before tax from continuing operations, 10%. That means profit before tax was 5 crores and 10% is 50 lakhs. The revenue, 2%. So you'll see what we have seen earlier, that the percentage applied to revenue will always be much smaller and the percentage applied to profit will be much higher. 10% was profit, 2% was revenue. So if the revenue is 50 crores, then the 2% factor comes to 1 crore based on, again, professional judgment. Net assets, since inventory is an important aspect, is applied 3% to 20 crores, which is 60 lakhs. The average of the above 3 criteria comes to 70 lakhs. So this is another way where we have taken into cognizance and given due weightage to profit, to revenue, and to net assets, and then arrived at a materiality value of 70 lakhs. This is the overall materiality concept that we have applied here. Considering the amounts calculated above using professional judgment, the engagement team consequently determines the overall materiality, as I said, 70 lakhs. Then the performance materiality is taken again at 75% of the overall materiality to be 52 lakh 50,000. And the trivial materiality is 5% of the overall materiality, which is 3 lakh 50,000. So here, though the stable company and therefore the percentages applied are relatively high, but we have taken into account all 3 factors for determining the materiality. Now, factors that may indicate the existence of one or more particular transactions, account balances, or disclosures for which misstatements of lesser amounts than materiality for the financial statements could affect the economic decisions of the user. So we may come across some circumstances where we determine a materiality. This we call specific materiality for a particular class of assets, where though we determine a materiality level, let's say in the preceding case, we determine a materiality level of perform materiality 52,50,000. But when we came into, while we're doing conducting the audit, we found that there were certain account balances or certain particular assets or disclosures where misstatements of a lesser amount were there. We have to then see whether law, regulation, or other applicable financial reporting framework affect users' expectations regarding measurement or disclosure of certain items. Example, related party transaction, remuneration of management and those charged with governance, amount paid as sitting fee to directors should be disclosed separately, precisely, and separately, irrespective of what my materiality benchmark was calculated earlier. So here we can't compromise on an inaccurate disclosure of the director's enumeration or related party transaction, because this is a specific requirement of Schedule 3 and also of the guidance notes of the ICI and of standards on auditing, that we have to disclose certain things, and here we cannot have inaccuracy. The key disclosures in relation to the industry in which the entity operates, example, research and development costs for pharma company. So in case of pharma company, again, R&D costs are very important and they have to be disclosed separately. So the materiality level, irrespective of what it may be, you have to scope this into your audit procedures. Whether attention is focused on a particular aspect of entity's business that is separately disclosed in the financial statement, that, for example, a newly acquired business by a company has to be separately disclosed, again, irrespective of the size and materiality of the figures. We come to revision of materiality. So this, once we have calculated the materiality, we have scoped it in, we have done audit planning, we are doing the audit. While doing the audit, we find that there are circumstances have come where we feel that there is a need to change the materiality, which is, again, this is an aspect which is allowed by the SA, that it is possible that while conducting the audit, you may feel the need to change the materiality, and you are allowed to do that. The auditor may revise materiality for the financial statements as a whole in the event of becoming aware of information that would have caused the auditor to have a determination, a differential amount initially. So if I come to know some information which I had known at the time of audit planning, I may have taken a different materiality at that time, then I can even change it later when I come to know of that information. Necessary to re-perform the calculation may be on the basis of the result of change in circumstances that occurred during the audit. For example, a decision to dispose of a major part of entity's business, or if the actual financial results are likely to be substantially different from the anticipated results, new information, or change in auditor's understanding of the entity and its operations as a result of performing further audit procedures. So if I find that I did a materiality calculation based on estimated turnover, and because of COVID, suddenly the turnover fell, then I will be required to recalculate my materiality levels, and I can do that while undertaking the audit function. So we now come to audit documentation, which is extremely important part of any audit, and materiality not excluded. We again have to document how we did the audit and how we calculated materiality, how we applied the materiality. And the audit documentation will include the following amounts, the factors considered in the determination. So materiality for the financial statements as a whole, that we just saw how we calculated the materiality. Then if applicable, the materiality levels or levels for particular class of transactions, account balances or disclosures. So suppose we also took a different materiality for different class of transactions, for example, RPT or management representations or management salaries, sitting fees, and we applied a different materiality level. We have to document that. Then performance materiality. How did we calculate the performance materiality? What percentage did we apply to the overall materiality to reach the performance materiality? And any revision that took place in the materiality while the audit progressed, as we discussed earlier, because of new factors coming into operation, new information coming to our possession, or any change in the factors on which we applied the materiality when we come to real actual figures. So this needs to be documented. So once we've done that, we have completed the whole aspect of materiality, which is SA 320, and on completion of SA 320, completing our audit scoping, our planning, our execution, arriving at misstatement, we reach at the last part that we have completed the audit and we have arrived at certain, based on our materiality level, we have arrived at certain misstatements. So what do we do about these misstatements? The guidance on that is given to us in SA 450. So we will now flow from SA 320 to SA 450. SA 450 will have the following general headings, which is SA 450's evaluation of misstatements identified during the audit. Overview will be basic flow of audit process as per SA 450, accumulation of identified misstatements, consideration of identified misstatements as audit progresses, communication and correlation of misstatements, evaluating the effect of uncorrected misstatements, communicating with those charged with governance, written representations, documentation, and references. The basic flow of the audit process as per SA 450 would be first to accumulate all the misstatements identified during the audit, then to determine whether overall audit strategy and audit plan needs revision. So sometimes we may feel that we have identified so many misstatements that we need to enlarge our audit plan, or it needs a revision, or we need to go enlarge it in certain areas of the audit. So do we need to change our audit plan and strategy based on the accumulated misstatements that we have identified, based on the initial planning of audit? Then to perform additional audit process procedures where management has detected and corrected a misstatement. So even where they have corrected a misstatement, then we may want to make some further corrections, or we may want to do some further checking to see have we left out any major amount which also needs correction. So we may want to do some further audit procedures in those areas, even though the misstatements have been corrected. Then communicate to the management and request correction. If management refuses understands it to do the correction, then to understand its reason and consider when evaluating whether the financial statements are free from material misstatement, even though the misstatement that we pointed out, the management did not correct. So do we still feel that the financial statements are free from material misstatement? So here the word is material misstatement. So if they're not material, then we can leave it. If it is material, then we have to go to the next step. Reassess appropriateness of materiality determined in accordance with SA 450. So we can also look at concept of materiality again and see whether we need reassessment, or we are happy with the materiality concept that we went with initially, since the management has refused to do the corrections. Determine if uncorrected misstatements are material. So based on our initial materiality calculation or revised materiality calculation, whether the uncorrected misstatements still remain material or not, then to communicate with those charged with governance and request correction, then obtain written representations. It happens sometimes that the management may have a different view to our view in terms of correction. So we will take a written representation from them that why they are not agreeing to our correction. And then if the amount is not material, we can accept that and go forward without qualifying the statement or giving any negative remarks on the financial statements. Accumulation of identified misstatements. We just discussed, now we are discussing each and every aspect of that chart that we just discussed. So we have identified misstatements. We accumulate all the misstatements during the year except those which are trivial, whichever, like we said, we calculate overall materiality, perform materiality, then trivial materiality. So whichever are smaller than the trivial materiality, we don't accumulate them. The types of misstatement could be factual misstatement, of which there is no doubt, judgmental differences arising from judgments of management concerning accounting estimates that auditor considers unreasonable. The accounting estimate could be useful life of an asset, or selection or application of accounting policy that the auditor considers inappropriate. So the accounting policy that are disclosed by the company for preparation of the financial statements, their application could have a different interpretation by the management and by the auditor. And if the difference of interpretation results in an amount which is material or not material, has to be determined. And then we have to see whether a correction is required. Projected. Auditor's best estimate of misstatements in populations involving projection of misstatements identified in audit samples to the entire population from which the samples are drawn. Just a small note here, the concept of clearly trivial, up to 5% of the materiality is often considered as clearly trivial. Clearly trivial does not mean not material. These are matters that are wholly smaller than determined in accordance with SA 320 and are clearly inconsequential individually or in aggregate by any criteria. If there are any uncertainty whether one or more items are clearly trivial, the matter is not considered clearly trivial. So the minute there is a controversy, then we don't consider it as trivial. The circumstances relating to some misstatements may cause the auditor to evaluate them as material, individually or when considered together with other misstatements accumulated during the audit, even though they may be lower than the materiality for the financial statements as a whole. Circumstances that may affect the evaluation include the extent to which the misstatements affect the compliance of regulatory requirements. These are some examples, not exhaustive, but they're just indicative. Affects other information that it needs to be communicated as per SA 720. For example, information include management discussion and analysis. As you know, friend, there is a management discussion and analysis now attached to the financial statement which the board of directors have to issue. And in that, there are certain financial figures also appearing, which are taken from the financial statement. So it has to be seen whether these are in line with the audited financial statements or not, or an operating and financial review that may be reasonably be expected to influence the economic decision of the users of the financial statements. So here also the evaluation, to the extent these misstatements occurred in those analysis, also have to be seen by the auditor, though we are as we are supposed to certify the accuracy of the same. Affects ratios used to evaluate financial position, results of operations or cash flow. So anything that affects the cash flow, the financial ratios, and the results will become material misstatement and will require a correction. Affects segment information presented in financial statement. Here also materiality level is not can be ignored, because segmental reporting is extremely important for the reader of the statements. Affects compliance with debt covenants or contractual requirements, etc. So wherever debt covenants are there and there's a information contractual requirements, then again we have to be careful while applying the concept of materiality. Determine need to revise overall audit strategy and plan if the nature of identified misstatements and circumstances of occurrence indicate existence of other possibly material misstatements. So once we have identified certain misstatements, which we may find are not material, however, the circumstances and the way they have occurred indicate to us that there could be some more misstatements of a similar type, which if accumulated together would amount to possibly material amounts. Then we have to change our audit strategy and audit plan. Aggregate of misstatements accumulated during the audit approaches materially determined as per SA 320. So these have to be materially accumulated that we discussed earlier. Perform additional procedures if at the auditor's request, the management has examined a class of transactions, account balances, disclosures, and corrected the misstatement that were detected to determine if misstatement remained. So even if like I said earlier, the management has corrected the misstatement pointed out by the audit, we feel that there could be some other corrections that could also be required to be done, then we may enlarge the scope of the audit to find those misstatements also, which the management has agreed, in addition to those which the management has agreed to correct. Communication and correction of misstatements. Once we found the misstatements, it is the auditor's duty bound to communicate the same on a timely basis, all misstatements accumulated during the audit to the appropriate level of management, unless prohibited by law or regulation. Request management to correct the misstatements. If the management corrects them, that's the end of the story. If the management refuses to make such correction, to understand its reasons and take into account when evaluating whether the financial statements as a whole are still free from material misstatements. So if the management has refused, you have to see whether taken the financial statement as a whole, the materiality of such misstatements is below the materiality level, and therefore we can ignore these misstatements and the correction not being done by the management, and we don't take any negative view of the same. Evaluating the effect of uncorrected misstatements. We have to reassess the appropriateness of materiality determined as per SA 320 in context of entities' actual financial results. So as we discussed earlier, we did the materiality calculation based on either the past results or the estimated future results while the audit planning was taking place. But when we come to the actual results of the company for the year under audit, sometimes they vary very drastically with the estimate that we had done. In such a situation, we can reassess the materiality based on SA 320 in terms of the actual result, financial results of the auditee. Then we determine if uncorrected misstatements are material based on the revised materiality level, individually or in aggregate. The factors to consider here would be size and nature of misstatement. So not only the size is important, but also the nature of misstatement. Are they the misstatements relating to statutory compliances? Are they relating to any statutory disclosures? Or are they only relating to a small difference in disclosure of printing a stationery amount being clubbed in miscellaneous expenses? So these are, and the amount being small. So they are not material misstatements. So then not only the size, but also the nature of misstatements is important. Particular circumstances of occurrence of the misstatement, then we have to go into how the misstatement occurred. Is it because of a fault in the maybe internal financial controls of the company? Is it because of a fraud that has occurred? Is it because the company consciously was trying to inflate expenses or deflate expenses, or is trying to inflate incomes, or cut-off procedures were wrongly applied, or a wrong understanding of the accounting policies of the company? So we have to understand how they have occurred and then determine whether they require correction or not. Effect of uncorrected misstatements relating to prior periods. So if these uncorrected statements relate to prior period, then appropriate disclosures will have to be done as required by the essays and the Schedule 3 requirements. As discussed earlier, we will need to then communicate with those charged with governance the uncorrected misstatements, identify material uncorrected misstatements individually, and impact individually in aggregate on our audit opinion. So we have to hear, this is the final concluding issue of, we have done the materiality, we have done the audit, we have revised the audit materiality, we have done the revised audit procedures. We then communicated to those charged with governance the misstatement. They did not correct the misstatement. Then we have to determine an audit opinion whether the true and fair view gets affected. For that, we have to see whether this materiality of this misstatement is above the overall materiality of the company that will amount to a qualification. If it is between overall and performance materiality, it may not amount to a qualification but may require disclosure or a written representation from the company on why they did not do the correction. We will also communicate effect of uncorrected misstatements of prior period, request correction of the uncorrected misstatement. So once all this is done, we have to basically see whether finally we are happy to give a audit opinion of a true and fair view, not happy to give a true and fair view, or we are happy to take a representation from the management on the uncorrected misstatements, or we need to enhance our procedures and go and do the audit at a larger level and enhance our audit processes again. The documentation of SA 450 shall be, we calculate the amounts for which the misstatement will be regarded as trivial, which is below our threshold limit, which we have left out. We have not asked the management to make corrections, and we feel that these trivial errors do not affect the true and fair view of the financial statement, and we can live with them. All misstatements accumulated during the audit and whether they have been corrected. So we make a documentation of all the misstatements, corrected or not corrected. Then we document the auditor's conclusion as to whether the uncorrected statements are material individually or an aggregate, and the basis for this conclusion. So this basis of conclusion could be that they are below trivial level. The basis could be that we accept the management explanation on why correction is not to be done, or the basis could be that we feel that the materiality of these uncorrected misstatements is not adequate for us to make any negative comment. So we will arrive at a conclusion, or the conclusion could be negative, that no, we feel that these were significant, they were material, the management should have done the correction. If they're not, then we will see how to modify our opinion. This is the part of the final documentation of SA 450. We will also take finally written representations from the management and those charged with the governance, whether they believe effects of uncorrected statements are immaterial individually or in aggregate to the financial statements as a whole. The summary of such are to be included attached to the written submissions, representations received from the management, and that concludes our effect of SA 450 and attending to the misstatement found during the course of the audit based on the principle of materiality. For this representation, we have relied upon the materiality in planning and performance audit SA 320, SA 450, and the implementation guide to materiality and planning issued by the ICAI. That's all, friends, that I have to present to you before today, and I'm happy to take any questions.
Thank you so much, sir, for such a wonderful deliberation, sir. I have received certain questions. Sir, is the maintenance of working papers in physical forms indispensable on auditees in case the auditor is working in a paperless mode?
Not necessarily. He can with hardly any guidance of anybody where you have to have physical mode. 99% of audit papers are now all scanned. In audits are conducted remotely. SAB audits are conducted remotely. The sampling is done remotely. So having the documentation in a digital form is absolutely fine.
Sir, bank audits are approaching nearby. So a member is asking your expert opinion to take these two standards in the bank audit. How to take material use of these two standards while auditing of the bank branch? Sir, you're not audible.
Just 1 second. I'll just get back. I think what needs to be done is, again, a similar way of calculating materiality. When we approach a particular branch of a bank, it also has assets, liabilities, advances, and incomes and expenditures. So materiality has to be again calculated based on the size of the branch. And for example, 1,000 crore branch advances would have a different materiality level. So according to me, when we did the branch audits, we calculated the materiality based on advances because that's the most critical part of a branch. And when you audit a head office or a central statutory audit, then the materiality goes up to a different level. So advances are a percentage of the advance is a very good benchmark for calculating materiality.
Sir, can you please throw light on performance materiality comes into the play while auditing? Performance materiality.
So performance materiality is a lower subset of the overall materiality. And it is normally 75 to 80% of the overall materiality. It gives you a lower threshold limit. And based on that, your audit scope and audit programs have to be structured. it is only the overall, when you find any misstatement which exceeds this materiality, but is within the overall materiality, it helps you determine whether you are going to qualify. You should have modified financial statement audit opinion or not. But the overall materiality is the overall threshold above which all the errors are intolerable. Between overall and performance materiality are errors which you need to correct and help you determine your audit processes. But mainly, your audit processes are based on the performance materiality, which is a subset of the overall materiality. We bring it to a lower threshold, because if we sometimes do audits based on overall materiality, the sample size becomes too large and it's difficult to do an audit. Once we are doing an audit and we find errors in a particular area of an audit, I can enlarge my audit scope to go to overall materiality at any stage. So I have an overall materiality threshold. I can use it anytime I want.
Yes, yes. So in order to maintain this materiality, because this is relating to the audit documentation also, so what basic documents we need to maintain as audit documentation evidence?
So I have already given that in both SA 320 and SA 450. It is given in the guidance, not only in the essay, but also the implementation guide. I will send you my this PPT presentation, and it says that audit documentation shall include the following amounts of factors considered in the determination materiality for financial statement as a whole we calculate. That's documentation. If applicable, materiality level or levels of particular class of transactions, account balances. Suppose you did a different materiality level for assets or inventory, then you calculate that. Then performance materiality, when you calculate, then you document that. Then any revision. So basically, we document everything that we do at every stage. When we document materiality, that is the documentation, calculation, how and why.
Yes. Sir, is there any fixed formula to calculate the materiality, fixed parameter requirement?
No. As you can see from the guidance note and the also the implementation guide, they've given 11 examples there. So every time we go into different circumstances, the percentages keep on changing. So that means the percentage of the materiality application is really a judgment of the auditor at the time from case-to-case basis to determine at what level he wants to determine his audit scoping and his audit sampling, and at what level he wants to leave it.
Yes. In case of the as in continuing engagements, each year materiality should be decided from step 1 or just be revised based on the previous year basis of materiality level?
I feel that because we are living in a very dynamic environment, we should do a fresh look at materiality every year. Just because we did a certain materiality calculation and percentage in the preceding year, we can use it. There's no hard and fast rule. If there's no change in circumstances, the business is same. There are examples again in the implementation guide where they say that the business is same, the turnover is almost similar, the profitability is same, there's no change in internal financial controls. And when we did the audit last year, we did not find any major misstatements during scoping of that audit. Then we can leave and we can even increase the materiality level to a higher threshold to give, since we have more comfort on the client.
Yes, sir, how to fix the materiality in case of consolidated financial statements and component materiality which are to be included in the consolidation?
So, it depends on, let's first come to the component of the audit, of the consolidation item. We have to send to the component auditor the materiality based on the overall percentage of that component in the consolidation. So, for example, if it is the overall component is only 5% of my total consolidated turnover, then I can give a lower figure of percentage of calculation of materiality to the component manufacturer, to the component auditor, who also has to apply his own judgment and give me a paper on how he calculated his materiality. And as a consolidating auditor, I have to look at his calculation of materiality to see whether I feel that is adequate for him to look at for us to consolidate that, and whether the procedures applied by them are adequate for me to give me comfort that this has been safely audited and the true and fair view has been checked. And it also depends on the nature of the component, business of the component that is being audited and consolidated. But it is something that the consolidating auditor has to look at.
Absolutely. Sir, in your presentation, you have given an example of misstatement relating to the statutory compliance. If a member is requesting to elaborate that example, suppose there is an act for which the company has not complied during the year, as it was applicable for March month only, and the amendment replied the auditor to comply with it, the act from April. Is it okay on part of auditor to agree with the amendment?
Again, depending on the materiality, here the materiality concept comes in, that it's not, suppose there is an act, for example, there are a lot of things where pollution control, I'll give you an example that I have faced, that some company had a notice from a pollution control board of the effluent treatment plant not working properly, and they had to spend some money on that, and they said, okay, we will do it in the next month. So that does not affect my company as a whole, and we did not take it as a misstatement. For example, another case, a small amount of TDS was not deposited on due date, but it was deposited subsequent to the auditing date. We can ignore it, and the amount is not very large. We can ignore that as a part of trivial materiality. So it depends on the nature of the statutory payment. If it is a huge amount of payment, for example, if there are payments to be done to the investor protection fund, and the company has not implemented payment of investor protection fund, then we have to report it, because that is a violation of law. So violation of law and delay in implementation law are two different things, because violation cannot be corrected next year.
Yes. Sir, can you put light on the instances when law prohibits to share the information with management and TCWG?
Just a second. I read this somewhere. Just give me a minute. So there can be circumstances where I'm doing a special audit on behalf of some agency, and my mandate of the audit, because we are not looking at audit, can be any audit, right? It's not just we're looking at statutory audit. It could be a 142 audit on behalf of the income tax department. It could be a special purpose audit from forensic audit. In such situations, it is given on page 14 of the materiality implementation guide, that prohibition by regulation may specifically prohibit communication or other action that may prejudice an investigation by appropriate authority into actual or suspected illegal act. In some circumstances, potential conflicts between the auditor's obligation of confidentiality and obligation to communicate may be complex. In such cases, the auditor may consider seeking legal advice. So what comes to my mind is forensic audit done on behalf of, suppose, a regulator asks you to do a forensic audit, it does not ask you and prohibits you in its mandate from communicating your findings to the those charged with governance, then you can't. But it's good to seek legal advice.
Yes. So what is trivial materiality and how it is different from performance materiality?
Trivial materiality is again a subset of the final smallest materiality, and it's calculated as a very small percentage of the overall materiality. So though there are three sets, overall, performance, and trivial, but trivial is calculated as a percentage of the overall materiality. And it, as the word suggests, clearly trivial. It's been used many times, and it says the word clearly trivial, that the amount is very small, and for which even if there's a mistake, I need not force the management to make a correction. The management may agree it's a mistake, but the amount is so small that it does not affect the reader of the financial statements or the persons who are stakeholders from taking any informed decision. Then, like we give an example, that if there's a mistake of 10,000 rupees in sales in a company of 1,000 crore turnover, it's a trivial mistake. So it's a trivial error, misstatement. Even if the correction is done subsequently and not in the financial statement, it does not amount to any mistake.
Sir, in your presentation, slide number 24, box number 3.
Yeah.
Is it the management detected and corrected misstatements or auditor detected and management corrected misstatements? Slide 24, box 3. Is it the management detected and corrected misstatements or auditor detected and management corrected misstatements?
Management detected.
It is management detected and corrected misstatements.
Yes.
Ji, sir.
It's also given in on page 11 of the implementation guide of SA 320.
Ji, sir. So second last question. For qualification of the audit report, is it performance materiality or the overall materiality to be considered?
Overall material.
Overall materiality considered. Sir, how interim materiality is different from the final materiality in regard to the sampling?
So interim materiality is normally when we start doing an interim audit or we do an audit planning, we may not have the final trial balance of the year end. Here, then what we do is we do a projection based on the preceding year and information received from the management on how the current year has progressed, which is under audit, and we calculate materiality. Sometimes it happens that either events occur during the year at the year end, or the estimation that is being taken is wrong, or we find major errors in certain areas, then we revise the materiality based on all these three factors.
Thank you so much, sir. Now we come to an end. Thank you so much on behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountant for sparing your valuable time and enlighten all of us on both these standards with a very detailed and vast deliberation in a very lucid manner. We have gained a lot. Hope our members have gained a lot through your deliberation, sir, and as well as your expert opinion, sir. Thank you so much, sir, once again on behalf of WSB. Thank you for sparing your valuable time, sir.
Thank you. Thank you so much. Thank you for inviting this deliberation.
Thank you. Thank you, sir. Thank you.